Today I'm going to discuss another important accounting standard, which is LKAS 2. Right? Inventories. LKAS 2 inventories. Right? So any accounting standard has their objectives. Right? Any accounting standard has the objectives. So when you take the inventory standard, there are three main objectives. First is to prescribe accounting treatment for inventories. What is the accounting treatment for inventories? Then to provide guidance on determination of cost. How to calculate the cost. First, the accounting treatment for inventory and determination of cost or the cost calculation, and to provide guidance on cost formulas. So three areas. Right? So there are three areas that we are going to discuss. Right. The scope. The scope is, now we here in this chapter, in this standard, we mainly focus on all the inventories. So what is an inventory? We will discuss. Like all the inventories which doesn't come under the scope of LKAS 2. Like if there are any other specific standard, like for an example, construction contract, LKAS 11, LKAS 32 and 39, financial instrument, biological assets. So if there is any specific standard, we don't take those into LKAS 2, right? And also products like forest products, agricultural products, mineral products, right? Commodity broker traders. So these will be exempt from LKAS 2. All other inventories or stock we will consider under LKAS 2. Right? So then let's see what is meant by inventories. The definition of inventories. The definition of inventories, simply it is, there are three types of inventories in a business. One is the raw material, other one is work in progress, third one is finished goods. Okay. Raw material, work in progress, and finished goods. When you are defining it, let's say in the exam, if you want to define the inventories, then you have to mention inventories are assets held for sale in the ordinary course of business. Held for sale means that is finished goods. Held for sale. Right? Or in the process of production. In the process of production means work in progress. WIP. Or in the form of material, which is raw material. So there are three types of inventories in a business. Right? So that is one definition. In the next definition, we are learning net realizable value. This is another important concept, NRV. Right? So I'll explain this from an example. I'll explain the NRV from an example. Let's say you have milk packets. We have milk packets. The cost of the milk packets is 100,000. This is the cost, right? And you are planning to sell. The selling price, expected selling price is normally it is more than the cost. If you purchase at 100,000, you probably sell this at 150,000, keeping 50% margin as for an example, right? This is a normal scenario. When you purchase at 100,000, you might sell at 150,000. Your cost is less, your selling price is more. This is the normal situation. But sometimes we might sell this, your expected selling price. You might sell this at a low price, let's say 80,000. Why we are selling at lower price? Now tell me the reason why we purchase at 100,000 and sell at 80,000. What could be the reason? What could be the reason to sell at a lower price? Yeah. So sometimes there can be damage stock. Yes. Stocks are damaged. Or expire date expired. It is close by. So because of this, you sell at a loss, right? So first scenario, if you are selling at a higher price, this is the expected selling price, right? So this is called the expected selling price, right? And sometimes, let's say we are selling at a loss, but if you want to sell immediately, you might have to spend for advertising and other selling expenses. Let's say there is a expected selling expense of 10,000 to have a banner or to do a marketing campaign. You need to spend 10,000 expense, right? So expected selling price is 80,000, expected selling expense is 10,000. So the net value is 70,000, which is called NRV, net realizable value. This is the net realizable value, right? So if you read the definition for NRV, it says NRV is the estimated selling price in the ordinary course of business less minus estimated cost of completion and the estimated cost necessary to make the sale. Right? That is this 10,000. Expected selling price minus expected selling expenses. Right. Then the third definition, I'll tell you another example. Let's say uh, we have a table, right? So to manufacture this table, there is a cost of 15,000. That's the cost. But due to a damage in the leg, one leg is damaged. Due to that, you are planning to sell this at 12,000, less than the cost, because you have to sell this somehow. So this is your expected selling price. Let's say you have to put a banner in front of your business, right? Saying sale, sale. They will say maybe 20% off. So likewise, some expense is there for to make the banner. So if the expense is 1,000, the NRV of this table is 11,000. So cost is 15,000. Cost is 15,000. NRV is 11,000. So there is a loss. How much is the loss? 15,000 minus 11,000. So 4,000 loss that we have to recognize in the business. We have to recognize in the business. Remember, if there is a profit, future profit, we don't recognize according to the realization concept. Future profits not recognized, but future loss you have to recognize. So that is the concept of net realizable value. Net realizable value. Okay. So then we have fair value. Fair value means the amount for which the asset could be exchanged or a liability settled between knowledgeable. Now here there are three important points. Knowledgeable, willing parties in an arm's length transaction. Three important points. Number one, both the buyer and seller. Now we have a seller. This is the seller, right? He is having a vehicle, right? This is buyer. Right? What is the fair value of this motor vehicle? Right? Let's say the seller is telling this vehicle is 1 million. Price is 1 million. Now to assume this as a fair value, is this a fair value? How to see whether this is a fair value? So you have three conditions. One is condition number one, both the parties should have the knowledge about the vehicle. And if the buyer doesn't know about the vehicle, he might buy at a very high price because he don't know the prices. He don't know about vehicles. So first condition to become a fair value is both the parties, buyer and the seller, should be knowledgeable about the product. And the second point is there should be a willingness to buy and willingness to sell. Seller should be willing to sell and buyer should willing to buy. Willing parties, willingness. Right? If the seller is having personal attachment with the motor vehicle, he might not sell at any price. So that is not a fair value. Let's say the seller is not ready to sell and buyer is telling, I will give you 50 million for this vehicle. Buyer is telling, I will give 50 million for this vehicle. So that is not a fair value because seller is not willing to sell. Right? Same way, same thing, other way around as well. And number three, third condition is it should be arm's length transaction. Arm's length transaction means අපි කියනවා අතේ දුරින්. අතේ දුරින් කියන්නේ no relationship. No relationship. So the transaction happens without any relationship. Let's say a father is selling the motor vehicle to the son. So he might sell at a very low price. Sometimes he might give free of charge. So that is not a fair value. To become a fair value, the transaction should be in an arm's length transaction. That means no relationship. Okay, right. So we studied what is meant by inventory. Inventory means finished goods, work in progress, and raw material. Then I was explaining what is meant by net realizable value, which is estimated selling price minus estimated selling expenses. Fair value means the amount where an asset is exchanged or liability is settled between knowledgeable, willing parties in an arm's length transaction. Okay. Moving to the next point. There is a doubt. Arm's length transaction again. Yeah. So arm's length transaction means, now let's say there are two friends. This is you and this is your friend. You have a mobile phone, right? Let's say there are two people. This is your friend. Now you want to sell this mobile phone, right? This is outsider. For the outsider, you are going to sell this at 10,000. For the outsider, you will sell at 10,000. But for a friend, you won't sell at 10,000. You might tell because it's your friend. But you can't sell at a normal price. You will give, okay, you give me 7,000, giving a discount because he is a friend. He or she is a friend. So this is arm's length, very close. The friend is close to you. So you will not sell at a normal price. You will give at a lower price. Right? So this is not considered as fair value. This is fair value. Is it clear? Right. Now let's move to the next part. Number one, I was discussing the definition. Right? Number two, the measurement. How do we measure? This is a very important point because this is useful for company final accounts and sole proprietorship, partnership, and other financial statement, preparation of financial statements. Right? So the measurement is the value of the inventories is measured at lower of cost and net realizable value. Right? So we always measure the inventory. We always measure the inventory whichever is lower of cost and NRV. Let's say if the cost is 100 and NRV is 150, then you take cost into the accounts. Right? If the cost is 100 and NRV is 80, then you have to take NRV as your inventory in the books. So the lowest amount only we have to take. Right here 100, here it's 80. Right. So when we prepare the financial statement, we have to take the lower of cost and NRV. In the next point, the cost of the inventory. Calculating the cost. Right. So when you take the cost of the inventory, cost has three parts. One is cost of purchase, cost of conversion, and all other costs related to inventories. Right. So cost of purchase means the purchase price. Let's say we are going to purchase tables. So our stock is tables. We buy tables and sell. Our supplier is in China. We import tables. Or we import material from China. Material. And we manufacture them in our manufacturing plant or our business. And we sell. Right? We purchase from China and we manufacture and sell. Right? So what is meant by cost of purchase? Cost of purchase means the purchase price. Let's say we are purchasing wood. The price of the wood. And there can be import duties, other taxes, transport cost, handling cost, any other directly attributable cost. Right? And also we will deduct trade discounts and any other rebates that we get. Discounts will be deducted. So these costs, this is your cost of purchase. Then you do the manufacturing. That is called cost of conversion. The wood is converted to table. There you will have direct labor, production overhead cost. It can be variable production, fixed production, any overhead cost that will be added. Right? Then other cost, like sometimes we will add the interest in borrowing cost, or sometimes let's take this example, cost of designing. Let's say there is a customer who wants to have a special design. For a specific customer, we make a special designing. So for that, you might spend some expenses. So that special expense or special designing expense is other cost. Right? So cost has three parts. The cost of the inventory has three parts. Number one is cost of purchase. Number two, cost of conversion. And number three, other cost. Other costs. Right? So let's move on to the next slide. I'll go through again. We discussed the definition. Right? What is meant by inventory? Then I was discussing what is NRV and what is meant by fair value. Then measurement, we measure the inventory at lower of cost and net realizable value. Then cost of inventories. Right? There are some additional things I didn't explain further because in our syllabus we have only the basic idea on this, right? If you have any questions, anything further, if you want to clarify, let me know. I will do it. Simply you remember there are three parts in the cost: cost of purchase, cost of conversion, and other costs. So this is how you calculate the total production cost. So if you can remember the manufacturing account, we calculate the total production cost by taking the primary cost, and manufacturing overhead or the factory overhead. These two are manufacturing overhead, and prime cost are the total production cost. So how do you take the prime cost? We take direct material, direct labor, and direct other. And indirect material, indirect labor, indirect other, which is related to the manufacturing or the factory, will be considered to the total production cost. Right? So this is how you calculate the total production cost in manufacturing account. Right. Next, these are not considered as cost. Right? So in the previous slide, I discussed what are the items which included in the cost: purchase price, import duties, tax, transportation costs, direct labor, production overheads, designing cost. Right? But these we don't consider as cost. Example: abnormal amounts, abnormal expenses, right? Not your normal cost, abnormal losses. Right? Suddenly there is a fire, inventory got damaged. So those we don't consider, don't include, not be included in the cost. Abnormal amounts, storage cost, right? Storage cost, store the inventory. Administrative overheads like salaries, electricity, rent related to administration. So these expenses, these cost, we have to take to the income statement. And selling cost, selling and distribution cost. So these costs we don't consider in the inventory cost. Okay. Abnormal amount, storage cost, administrative overheads, and selling cost. Then the next point. So this is an important part, cost formulas. You will get questions related to this. Cost formulas. Right? So actually there are two methods, right? How do you calculate the cost of the inventory, or how do you calculate the remaining value of the stock and the cost of sales? If you can specifically identify how much, what are the items that you sold, then you can use specific identification of cost. If you can specifically identify the cost, let's say for an example, you are buying and selling books, right? You are buying and selling books. So each book, the price is different. Let's say one book you purchase for 1,000, another book you purchase for 2,500, another book 4,800, another one 1,500, and you sell. Only book 2 and 3 you sold. So you can specifically identify the cost of these two. only you are selling these two books, so that you can specifically identify. If you can specifically identify, you will use specific identification cost. But most of the time, this is not the case. Most of the times, you will have similar items. Like let's say milk bottles or any FMCG products like soap or detergent, toothbrush. So these products you purchase at different price. Similar products we will purchase at different prices because of the inflation, because of the price changes. Like let's say you are buying and selling pens. That's your business. Buy and sell. Right? Maybe in January you buy pens at 6 rupees. In February you might buy this at 8 rupees. And in March you might purchase at 750. Right? Same product, but each month the price is different. Maybe because of the dollar rate is changing and inflation and government taxes. Because of many reasons, the prices are changing. Right? We can see every day the prices are changing, the dollar rate is changing. Right? So if that's the case, we have three methods: first in, first out, last in, first out, and weighted average cost method. And last in, first out is not used anymore. Right? We mainly use first in, first out, and weighted average cost method I will be explaining later. Right? So there is a doubt. Let me explain again the specific identity. Specific identification is you know specific cost. So normally that happens for a large products. Let's say we are we'll take an example, a tailor, right? So there is one customer who comes to give an order. So he need a shirt. So he select the material and he tell the design, material, and he tell the design. Then the tailor will stitch and give the product. So he know how much material is used, what are the other costs for that, right? Then he will decide the selling price. So that is specific identification of cost. Cost can be easily, specifically you can identify. Everything else, use these methods. Right. So let's move on to the calculations now. This is very important, right? Cost formulas, because we have past paper questions on this part. So let me explain some examples. Okay, so take your books and let's do the calculations. Right. So you can do the calculations with me. I'll take a simple question first. Mm, Give me a minute. Right. So let's do this question. So this is the question. Bimal runs a hardware. As at 1st of January 2014, that is at the beginning, he had at his stores 600 bags of cement valued at 900 rupees. Right? So at the beginning, 1st of January, he is having 600 cement bags which was valued at 900 rupees. Then the movement of the stock of cement bags during the first week. 2nd of January, purchased 400 bags, 905 rupees each. 4th January, selling 700 bags. 6th January, purchased 500 bags at 910. So you can see the prices. At the beginning, it was 900, then purchased at 905, again purchased at 910. Calculate the value of stock using first in, first out method. Right? So let me explain how to do the calculation. Can you tell me how much will be the answer? I'll give 2 minutes for you all to try. After that, I'll explain. What is the answer? I need the amount. what we can do is we can prepare a stock ledger. So I'll show you the format of stock ledger. Right. I'll show you the format of stock ledger. This is an important point because we can expect questions from this part. So this is the question, and this is a format of stock ledger. First in, first out. We have date, receipt, issues, issued, and the balance. Right. So when it comes to, you all can draw this if you don't know. The date, 1st of January. There is a balance of 600 units, 600 bags, valued at 900 rupees. So the total value is 540,000. Right? So that is opening balance. Then what happens is 2nd of January. There is a receipt. Receiving 400 bags, that is purchases. 400 bags, unit price is 905. So the amount will be 400 into 905. So that comes to 362,000. Right? At the beginning you had 600 units at 900, purchased 400 units at 905. So the remaining balance, see how I am writing this. You can separately write 600 bags at 900 rupees, 400 bags at 905 rupees. So total amount is 540,000 plus 362,000. Right? So that's your purchase. Right? So 600 bags at 900, 400 bags at 905. Total, there is 1,000 bags. Total, there is 1,000 bags. Then what happens is, we are selling 700 bags. Now when you are selling, this is where you need to understand the first in, first out. First in, first out means when you are selling, you have to issue the first in stock. Now first in stock is this 600 bags. So first you will issue this 600 bags. This entire 600 will be issued. Right? And from the remaining, now you need 700 total to issue. So out of this 900 worth of bags, you will issue the entire 600. Then another 100 you have to issue from the remaining 400 bags. Right? So issues will be 600 bags, 600 cement bags issuing at 900. We have to issue at 900. right? Another 100 bags you have to issue at 905. Then total 700 bags will be issued. Then the value 600 into 900 plus 100 into 905. So total 630,500. So the remaining is only 300 bags out of 1000. When you are issuing 700, remaining 300 bags, which was valued at 905. So remaining amount is 271,500. 100 came. There is a question. How did the 100 came? 100 came like this 600 is issued. Right? Now you need to issue 700. So if 600 was issued, another 100 is remaining. So that 100 you have to take from this. So out of 400, if you issue 100, remaining is 300 from this. Is it clear? Now you need to do the next. Right. So that was 4th January. 6th January, there is a purchase of 500 cement bags at 910 rupees each. So the value is 500 into 910, 455. Then the closing stock, 300 bags at 905, 500 at 910. So closing balance 700, 271, 500 plus 455, which is 726, 500. So this is the answer. Calculate the value of stock using first in first out method. Value of the stock is 726, 500. Okay. Now let's do another question. Let's do another question. Again, first in first out. So let's do this question. Can you all find the answer? So the question is, Vishwa has computer accessories center and sells USB 16 GB pen drives. As at 24th December 2013, he had an his he had in his store 35 pen drives, each costing 1,500. And his sales and purchases during the last week of December 2013 were as follows. Right? So there are five transactions. So let's try to calculate the values based on first in, first out. We are required to prepare the stock ledger using first in, first out method and calculate the value of inventory as at 31st December 2013. So first balance 24th December. Balance was 35 pen drives at 1,500 rupees each. Right? So if you multiply 35 into 1,500, it will be 52,500. 52,500. That's the opening balance, 24th December. Then let's do the transactions one by one. 25th December. Purchases means receipt. 15 units at 1,525. So total you have multiplied. $22,875. So at the end, there are two types of stocks. One 35 units purchased at 1,500, 12 units, 15 units purchased at 1,525. So total amount 52,500 plus 22,875. The total into 75,375. Then there is a sales. Selling 38 units. Selling 38 units. So how do you sell 38 units? First, in first round. First you will sell this entire 35 units. And remaining 3 units you have to take from 1,525 stock. So 35 units from 1,500, 3 units at 1,525. So total 35 into 1,500 plus 3 into 1,525, which is 57,075. Then the remaining stocks will be only 12 units. Entire 35 units was sold. Out of 15, if you sell 3 units, 12 units remaining at 1,525. Remaining balance 18,300. We will do the rest and calculate the total, the closing stock. Okay, this is 26th. 28th December, there is another sale. Sale of 10 units at 2000. Now there are 12 units. Out of this 12, 10 units we are selling. Price is 1525. So value will be 15,250. Remaining only 2 units. Remaining only 2 units. Value is 1520. Out of 18,300, 15,000 deducted. 3,050 is the balance. Then we have 29th. 29th December. There is a purchase. There is a purchase. 25 units. So we will write 25 units purchased at 1530. Amount is 25 into 1530. So the stocks are 2 units at 1525 and 25 units at 1530. The value will be 1050 plus 38,250. Total 41,300. Then there is a sale. This is 30th December. 12 units. So how do you sell 12 units? These 2 units plus 10 units from this. Right. So 2 units from 1525. 10 units from 1530. In the answer, two into 1525, 10 into 1530. So 18,350. Remaining 15 units. 1,500. 41,300 minus 18,350, which is 22,950. 22,950. So this is your closing stock value. Right. Now let me explain. Any questions from this? Now this is weighted average, the first in first out method, right? So this is the stock ledger first in first out. There is another method, right? So we need to know that as well. So that is weighted average method. Okay. So let me explain that also from the same example. Stock ledger average cost. So we call it AFCO, average cost. Right? So you all can draw this format again. Average cost method. So this is very simple. So in this average cost method, opening balance will be same, 35 units, 1500, 52, 500. That is opening balance. Then there is a purchase. 25th December. How many units? 50 units. 1525. So multiply 22,875. Right. Then when you are writing the balance, so you don't need to show the balance separately like FIFO. Here we can take the average price. So what is the total number of units? 35 plus 35 plus 15. So total number of units will be 50 units. Total value will be 52,500 plus 22,875. Then if we can get the average price is this divided by amount divided by number of units. Amount divided by number of units will be average price. Right? So you get an average price for this. Then we are selling 38 units. Price you have to take average price. Then if you multiply 52, 57 to 85, so remaining stock is this. Price will be same. Then we have 28th December. After 26, 28th December sales. Another 10 units. Price will be same. So 2 units remaining, same price, 3015. Next, after 28, we have 29. Purchases, 25 units, 1530. So total 27 units. Let's calculate the amount, 38,250. So total amount will be 3015 plus 38,250. Then the average price becomes 1528.33. Finally, selling 38th December, selling 12 units. Price is same. 18,340. So remaining inventory will be 15 units. Valued at 22,925. Average price becomes 1,428.33. So you can see the difference in first in, first out and the average cost. First in, first out 22,950. Average cost 22,925. So 25 rupees less in average cost. Closing stock value. So I hope you understood the first in, first out and average cost method. Any questions? Any doubts? Now, can you all tell me the answer for this? What is the answer for this? Which of the following techniques are allowed under LKAS 2 inventories in determining the cost of inventory? It is very simple. D. Which of the following techniques are allowed? So we discussed two costing methods: weighted average cost and first in, first out. So LIFO won't count. Last in, first out won't count. Very good. So I want you all to tell me the answer for this. What is the answer for this? Which of the following statements is correct? When the unit purchase price of a particular raw material item has been increasing over the accounting period. So prices are increasing. When the prices are increasing, what is the correct statement? Tell me the answer. What is the answer? Number one, A. It says value of the closing stock under the first in first out method would be lower. Second one is cost of raw material consumed. The cost of sales. First in first out method would be lower, less. Just tell me the answer. Right or wrong, any answer is okay. Okay, so we'll see the answer. Now, when the prices are increasing, the closing stock in first out, high or less? The closing stock will be the last purchase price. So therefore, the closing stock is high in first out method. Because in the closing stock, you will have the last purchase price. Value of the closing stock under first in first out method would be higher, not lower. So first one is wrong. First one is wrong. Cost of sales, cost of raw material consumed. It is cost of sales in first out method. So if the cost of closing stock is high, the cost of sales will be less in first out method. So this seems to be correct. In first out method, the cost of sales is less. Because the closing stock is high, the cost of sales is less. So answer is B. Let me explain the other two as well. Cost of raw material consumed in a particular period, both under the first in first out method and weighted average cost method will be same. No, it is not same. In our previous question we discussed. FIFO and weighted average cost method will have no impact on the cost of production. No, there is an impact on the cost of production because it affects the closing inventory. Answer is B. So those are the areas in the case 2. Any questions? Any other questions? Fine. So next I'm going to explain another important chapter, case 8. A small chapter, right? In case 8. It's very simple, right? Just go through this. Case 8 is accounting policies, estimates, and errors.